Perfect, perfect. Yeah. This is Travis Montgomery. I'm the Director of Marketing here with the Multifamily Investment Advisors Group here at KW Commercial and Keller Williams One Chicago. Basically, we're going to start off by saying just number one real estate firm in the U.S. where we've secured over 404 billion in sales volume for 2020 alone. Our team specifically focuses on the multifamily assets where we're actually sourcing exclusive opportunities. And we actually do that by taking a novel approach where we're able to strategically work with the client to make sure that our clients' goals are accomplished. So I'm actually going to go ahead and let Tony Hardy, who's our executive director, start by going over some national real estate information.
Awesome. Thanks, Travis, for passing me the ball. Yeah, I think sometimes we take those numbers for granted. But yeah, we're the only firm in the United States that closed about $1 billion a day in real estate transactions. A lot of firms are hopeful to do that in a year. I'm gonna share my screen. Do a screen share and go over a few quick slides. I'm not gonna go too deep into it, but I will share some trends that we're seeing in the Chicagoland multifamily apartment market. Similar to the rest of the nation, the Chicagoland, are you guys able to see this? Okay, awesome. They're similar to the rest of the nation. The Chicagoland multifamily witnessed a pronounced slowdown in sales activity in 2020. And you can see how it kind of dips down substantially. With the market failing to hit, we didn't even hit $2 billion in our MSC in multifamily sales in 2020. That's the first time that we haven't done that since 2010. We were close. We were at 1.9 billion of total sales, but our average has been about 2.6 billion, which is less than half of what occurred in 2019. The pullback in sales is largely coincided with the onset of the coronavirus pandemic, as the significant rise in uncertainty and the period for time logistical difficulties in underwriting processes. In other words, some of the larger investors, institutional investors, began to hit the pause button as things occurred, even though we did get off to a robust start in the beginning of 2020. While each Chicago geographic district, the CBD and the suburban districts witnessed a pullback in activity, the largest decline in sales occurred in the suburbs. This was an interesting dichotomy because the fundamental performance in the suburbs actually was significantly stronger during the pandemic than it was downtown. South Michigan Avenue, due west of Grant Park, although there was a 479 unit property, fetched the highest total in Chicago overall at $396,000 per unit. That was still lower than we saw downtown Chicago prior to the pandemic. The property was Essex on the Park, was over 25% vacant at the time of closing. And they're still working to stabilize that property even now. Thus, while it's likely the recent double-digit decline in rents in high-rise properties in the downtown Chicago weighed in on the asset's value, so too did the property's elevated vacancy rates. Thus, while the Essex on the Park is a relatively lower transaction price in value, is noteworthy, it's not likely true post-pandemic barometer of high-rise pricing in downtown Chicago. A further headwind to multifamily sales activity and pricing in the Chicagoland market is due to a lot of concern around the magnitude of future tax increases, given local given the local situation, the fiscal situation of Chicago and Cook County. These concerns are exacerbated in Cook County, where recent modification to assessment methodology have resulted in large increases for many commercial property owners. The city of Chicago will be reassessed here in 2021, and most market pundits are expecting relative tax burden on commercial property to grow significantly once impacted. The reassessments are going to be felt in 2022. In addition to this, Mayor Lightfoot recently proposed fiscal 2021 budget, and that budget did propose a significant property tax levy, which they did say they were going to lean pretty heavily on commercial properties. Thus, it is highly likely that multifamily landlords in the city of Chicago will see a meaningful rise in property tax expenses over the next few years, given there's much uncertainty surrounding the magnitude of further increases and assumptions, a factor that is combined to recent pullback of institutional investment activity within the city. Despite the slowdown in activity, cap rates have largely held steady over the past year. I attribute part of that to lower interest rates, and still we're getting pretty favorable terms from pricing. Contributing to this stability has been the highly accommodative financing environment, which has thus far helped many landlords avoid distress that plagued pricing during the last downturn. Even still, the average market value fell by nearly 4% in 2020 due to falling net operating incomes. Looking forward, cap rates are forecasted to inch up slightly over the near term, while the NOI is forecasted to fall a little bit during the second quarter of 2021. As such, multifamily values are expected to decline further by about 2.5% before rebounding back later in the year. So that's what I have for you guys. We have been seeing rents change, notably here in the CBD district. They're looking at a 12.1% decrease in asking rents over what they were a year ago. That's pretty substantial. And the vacancy rate in CBD has been higher, as high as it's been on record, right? Since we've been tracking these numbers. Notably recently, we have been seeing a lot of concessions to get people back into these units, back into the fold. And they've been having a limited amount of success, but still the vacancy rate still remains pretty high. So I'm going to turn it back over to you, Travis, and stop the screen share now.
Thanks for that information, Tony. I'm going to take a brief second here. I saw a question come in through the live chat. One of the questions asks, have you all been noticing any updates regarding developments? I noticed that they took a slowdown when COVID first started, but I'm starting to see some updates regarding some upcoming developments for Chicago. I think that'd be a great question for Jason York to answer. He's also a part of our multifamily investment advisors team here. Jason, floor is yours.
Thanks, Travis. Yeah, we're definitely seeing a lot of developments going on right now. I'll actually just touch on two developments that I want to kind of highlight. One's going to be in the Uptown neighborhood in Chicago, and I'll also touch base on the Micro Reese development as well. But just to kind of kick it off, the development in Uptown is actually called Uptown 4611, and it's a former single-story city sport retail building. And this development is exciting because they're going to redevelop it into a 9-story multifamily building, which is going to include 200 residential units and also include 12,000 square feet of retail space. So that's huge. 200 units will be great. And then it's also directly across the street from the newly constructed $203 million Wilson and Broadway station. So definitely transit oriented, and it's also right next to the Chicago Market Co-op grocery store. So this development is going to play a huge part and huge role in growing that Uptown community. So I know that's going to be exciting for the Uptown neighborhood. And then also the Michael Reese development. We kind of saw some news come out a couple weeks ago regarding the step forward that Michael Reese development kind of took. And this is huge because that Michael Reese development site is going to take 49 acres of space and redevelop it into a mixed-use campus over the next 2 decades. So the first phase, which is about $600 million worth of, redevelopment, it's actually going to revitalize the southern end of the property, and that's going to include the 500,000 square foot Chicago Arc Innovation Center, which is going to be kind of an anchor for that development. And then it's also going to feature, some retail space, community center, as well as a park. And, this is also going to have some senior housing buildings, as well as the senior pavilion, which is the only remaining, structure from the original Reese complex. So it's going to be a mix of kind of renovating some old buildings and then also a lot of new construction that's going to take place in that first phase. And that infrastructure construction is actually expected to begin this year. So those are some two developments that we're seeing that are getting a lot of attention, and it's definitely going to be the Michael Reese redevelopment is definitely exciting for the Brownsville area. So those are two developments to look out for.
Thanks for answering that for us, Jason. And I saw a couple people actually did request some additional information regarding that Michael Reese development. So what we're going to have Jason do is just pop in his email in the chat box there. If you all have any questions regarding that development or want some additional information, please feel free to reach out to Jason. He'll be able to answer all those questions. I see another great question coming in through the chat. Please, I encourage everyone, if you have any questions, please feel free to put them in the chat box and we'll be able to go over them. The next question I have coming in is Chicago still a desirable landing spot for investors? I know Vince had a similar question last week that he answered. I'm going to let him handle that.
I appreciate that, Travis. Well, there's a lot of factors at play when you analyze that question. Certainly, the low-hanging fruit is that for the last 7 years, Chicago has experienced the population loss. So population is trending down. There are concerns regarding public corruption, controversial school systems, stable school systems being the number one concern for Generation X property buyers and renters, and, crime reports as well. But nonetheless, residential markets in Chicago do reflect the all-time highs that we're seeing nationwide, and Chicago actually exceeds the curve nationwide in that regard, in many regards. Chicago is still a city that is comprised of 50% renters. So in terms of the multifamily investment pool, that is a very desirable statistic. With 12 Fortune 500 companies making their home here in Chicago, you have that big city opportunistic atmosphere, whereas, you can get in for a lower kind of statute. New York, you're nearly at $1 million for your average sale price of a property. LA, you're in at $500K for your average sale price of a property. Chicago, you're just above 300,000 as of a metric that was taken in January. So, you kind of have that room for growth, room to add value for investors. They're still coming in. Jason just mentioned some interesting developments. I always like to key on the developments because they do drive the traffic, most of which being the Obama Library, the storied kind of development that's been talked about the last few years. As I keyed in last week, we'll be breaking ground this summer. That was just announced here this past month. So we definitely have a hopeful outlook for the investment community in Chicago. And I think we'll see the fruits of it as Tony's prediction indicated.
One of the things I want to add there, Vince, is most you're correct. There's 12 Fortune 500 companies within the city limits of Chicago proper, but most times when they're reporting on Fortune 500 companies within, they usually look at the whole metro, the MSC, and in our MSC, there's 36, and not to mention all of the companies like Boeing and some of the other ones that have second headquarters here in Chicagoland, I should say. And another reason that these companies are continuously attracted here is the plethora of talent coming out of some of these very strong institutions like DePaul, Northwestern, University of Chicago, and the list goes on and on. So I want to give it back. I just wanted to chime in a little bit, and I really thank you. Appreciate your presentation there.
Thanks for that, Tony. Definitely. Another question coming in. I see it has to do with the ADU pilot zone there. The question has to deal with, I think I might have a multifamily that's actually in the Northwestern pilot zone. Do you have any information that you can share with me for that practice? Cody, once again, I know that was a question you answered last week. Gladly give the floor to you to answer that once again.
Oh, awesome. Thanks, Travis. Yeah, there's new ordinance allows for the creation of ADUs in 5 pilot zones scattered on the north and then west sides of Chicago. This is huge for investors. It's a fantastic way to force appreciation for your assets, potentially without even needing a zoning change, which is what they push so hard for. In regards to how existing non-conforming units will be treated, I know that's been a big question. They'll need to meet new building codes, and they'll need to meet the size requirements for these ADUs as well. And that's both for coach houses and additions that have been added to assets as well. The requirements now, there's some limits on new structures that can be built. You can't quite go above 22 feet in height. And if you're building more than 2 units, you're going to be subject to making one of them affordable housing. And if you want some quick math just to stay on track of what needs to be affordable, it's 50% rounding down. So 6 or more units, for example, half of those units would need to be at 60% of the average median income. And then you can apply that going forward with more ADU units. But this is a great thing for Chicago. City's been against it for a really long time. And what we're getting now is an extra, in some cases, $10,000 a year, which is fantastic for our property values and our appreciation for when it comes time to refinance, sell, or anything that you want to do with that asset.
Great, thank you for that, Cody. Once again, if anybody has any questions regarding the ADU pilot zone or want some additional information, Cody's going to put his contact information in the chat there, and please feel free to reach out to him. We have some really great information that we would love to share with everyone. I believe we actually do have some opportunities in one of those Northwestern pilot zones. I'm going to let Mo take that over.
Thank you, Travis, for the opportunity. Yes, we actually have a 4-unit opportunity in the highly desired Palmer Square, which is a sub neighborhood in the Logan Square area. It's 100% occupied, and yeah, it's a great property, well maintained. It has some capital improvements made over the years, updated plumbing, exterior, interior, some updated electrical, updated siding, included washer and dryers in each unit. Some updated meters. It's a great opportunity. Gives the investor to pretty much come in and start receiving cash flow from day one. And look into the future, there's also some opportunity for growth with duplex in the first floor units down. So having that option to duplex the units down, you can increase the rental income by about $400 per unit for both first floor units. And that's prior to doing anything with ADUs. So mentioning the ADUs is like the cherry on top. So that has the opportunity to turn a 4-unit into possibly a 6-unit with adding, or if you want to add a coach house or anything like that to make that investment or that asset even more attractive.
Thanks for that, Mo. Once again, any additional information, we'll get that over to you as soon as possible. Tony, I know you went over the national trends for the real estate market. How do those national trends affect the local market here in Chicago?
Sure. Yeah. Chicago being 77 different neighborhoods made up of different, different micro markets and sub markets makes it a lot more, you're able to kind of pick your poison. If you're looking for a 6 cap or a 7 cap, there's a neighborhood for that. If you're chasing a higher yield or more stability, there's a neighborhood for that. We can typically pair you up with a neighborhood and an investment that'll pick your poison. I think one of the guys, I think Danny on the call, says he's looking for $1 million to $2 million investment on the north side. Not too many of those out there, right? The north side gets north of $2 million very fast. However, I think this opportunity may be worth looking at because of the value add component. It's in the ADU pilot zone, so there may be an opportunity to add a couple units. Those units on average are rented for, I believe, north of $2,000 a month, or duplex in the first floors down. The second floors have already been duplexed up. First floors can be duplexed down, which could add $400 or $500 in increased income. So we've been seeing actually the south side of Chicago, the west side of Chicago, and the suburbs actually outperforming the core central business district, which is a first, right? We've seen this before when the condo conversions were heavy, right before the bubble, I believe in 2002, right before the bubble in 2008. We didn't get much warning, but sometimes that's an indication of things to come. But yeah, the Chicago market remains robust. Even though there are a lot of headwinds coming at owners, we are able to identify some opportunities. I want to give it back to you, Travis, for the sake of time. I know you may have a couple other guys you want to get to, and feel free to reach out to me online or reach out to anybody on the team for additional information about specific neighborhoods or specific properties.
Thanks for that, Tony. Thanks for that. I'm just going to share a brief link. Sorry, there it is. So that's a link to the Southside Community Investors Association. They had some really good information that they were sharing regarding lending practices. Please feel free to check that out if you have any availability. One quick update, Drew, can you inform us of any capital markets updates?
Sure. Thank you, Travis. So last Monday during this meeting, the 10-year Treasury was at 1.36, and it's currently up 7 basis points since our last meeting, and it hit a high of 1.54 last Wednesday, which has led to a volatile week in the stock market. These rising rates indicate a strong economic recovery coming sooner than expected, but the Fed still has no plans to rise rates around the board. Rates are eventually going to rise to combat the debt that we have, and but the Fed has recently come out and said short-term rates will remain near zero until the economy reaches max employment and inflation tops 2%. Inflation as of January is at 0.62 right now. And the Fed has also said that they will continue their monthly purchase of $120 billion in T-bonds and mortgage-backed securities in an effort to hold down longer-term interest rates, including the 10-year.
Thanks for that information, Drew. I see that brings us right to our 12:30 mark today. Don't want to keep you all any longer. If you have any topics or any questions that you want to share with the team, please feel free to include them in the chat right there. We'll love to go over those next week when we have our Monday's multifamily investment market update every Monday at 12 p.m. And you all have a great day.